Well, here we are, the last South Coast Snapshot for 2022. Whilst we're still on the tools in the office, we're taking a short break from the weekly videos until early next year. So let's jump into the latest. The Reserve Bank of Australia has a massive trick up its sleeve. The potency of this gambit is still very much underappreciated. In its latest financial stability review, the RBA published a chart on the share of fixed rate mortgages in Australia, New Zealand, Canada, the UK and the US. New Zealand and the US are sitting at or above 90% of all home loans. The UK is north of 80%. Canada is just shy of 70%. The construction of Australian Aussie mortgage market is, by the way of contrast, radically different. Historically, less than 20% of all loans have been fixed. As a result of the RBA generously lending $188 billion of 3-year fixed rate loans to the banking system at an annual cost of between 0.1 and 0.25% during the pandemic, the share of fixed rate mortgages surged to almost 40% of the total stock. The RBA estimates that around 23% of all Aussie home loans, worth almost $500 billion, are fixed rate and will switch to variable by the end of 2023. National Australia Bank Chief Ross McEwen says Australia's relatively small size and state-based planning and construction regulations cast a cloud over the potential returns on offer from social and community housing, as the government urges big finance to back its housing affordability plan. Treasurer Jim Chalmers and the Housing Minister Julie Collins hosted about 20 of the nation's most powerful banking and superannuation executives for a closed-door meeting aimed at shoring up their support for a housing accord unveiled in the October budget. But while Dr. Chalmers said his plan to build 1 million homes in 5 years had been met with enthusiasm, from the big end of town, some of the high-powered guests at the round table warned of barriers that needed to be cleared before they could get behind the initiative. Sydney's office vacancy rate could soar to nearly 20% within 4 years as white-collar hiring slows, and expansion in the tech sector, previously a big occupier, faces headwinds, according to Macquarie. Despite a super tight jobs market, there are indications that employers are becoming more cautious on hiring intentions as the business outlook becomes cloudy, according to a Macquarie analysis that draws on a survey of 129 recruiters. A year ago, 84% of recruiters expected employers to expand their headcount. That figure has now halved. Sydney house prices could bounce back by up to 9% next year if the Reserve Bank of Australia pauses interest rate rises, keeping the cash rate below 4% according to the Boom and Bust report. Lewis Christopher, Managing Director of SQM Research and author of the report, said a pause in the rate rise cycle, which is expected to occur as early as June next year, with the cash rate holding steady for the rest of 2023, could ignite a recovery in the dwelling prices across the biggest capital cities. That scenario assumes that interest rates will peak at 4%, inflation hits 8% but falls back to 5%, and that the unemployment rate rises but stays below 5%. If the RBA were to hold it below 4%, given the surge in the economy that accelerated wage increases, I believe that will create grounds for a housing market recovery, albeit a soft one, where we would see some single-digit house price rises occur in 2023, or at the very least a situation where the housing market would stop falling. In this base case scenario, Sydney house prices are predicted to rise between 5% and 9% next year, the sharpest gain of any capital city. Sydney is expected to lead the recovery, driven by the surge in underlying demand for residential property and its diverse economy, Mr. Christopher said. Rental affordability is crashing across the country and is now at record lows in several capital cities and many regional centres, as stagnant wages combine with low vacancy rates and climbing interest rates to price people out of places to live. The Rental Affordability Index, released on Tuesday by SGS Economics and Peak Body National Shelter, shows affordability dropped by up to 14% in some parts of the country over the past 12 months. The annual index, which compares rents to household incomes, shows Hobart is the nation's least affordable capital. Affordability is at a record low in Brisbane after an 11% drop over the past year and at its lowest point in Perth since 2016. In both Melbourne and Sydney, National Shelter expects affordability to tumble after briefly improving during the COVID-19 pandemic. Asking prices for homes on sale in some Sydney and Melbourne suburbs that were hit the hardest by rising interest rates are starting to pick up, a move that could eventually pave the way for a recovery in the broader market, industry insiders say. Analysis by Suburb Trends found that some markets that have been falling for 6 months, and by that at least 15%, are now posting a rise in asking prices amid falling inventory levels. By tracking the month-on-month changes in both inventory and asking prices, we can see some green shoots appearing, said Kent Lardner, founder of Suburb Trends. House prices across the country are on track to fall 18% and not start rising until 2024, one of the nation's biggest lenders has predicted, amid warnings the rental market will become even more expensive as overseas workers return to Australia. ANZ economists on Tuesday said that Sydney prices were likely to fall by 12% this year and another 8% in 2023, while the Melbourne market faces back-to-back drops of 8 and 9%. Mortgage affordability is now at its worst level since the 1990s, despite property price falls, new modelling shows. Home buyers are facing the worst purchasing conditions in 3 decades, thanks to the fastest rate rise on record. In addition, national average house prices are more than 6 times the average household income. The rate rises have wiped out any improvement from the recent house price falls. The national mortgage repayments ratio is currently 42.8% of incomes, the highest level since the September quarter of 1990, where it was 45.5%, Beta Shares modelling found. It has also overtaken the GFC peak of 42.1% in the March quarter of 2008. New home buyers are caught between rising interest rates and falling home values, with many forecasts to slide into negative equity by the end of 2023, new analysis has found. Now, negative equity occurs when the market value of a property falls below the sum of the remainder of the mortgage, and essentially means that the borrower owes more to the bank than the property is worth. The average new capital city apartment owner who bought with a 10% deposit in November 2021 will fall into a negative 5% equity by the end of 2023, while those who purchased a house will be in a negative 4% equity, the Rate City analysis of ANZ house price forecast and CoreLogic data has found. So the next time we speak, we'll be right in the middle of our Ray White South Coast January auction event, 50 properties, 1 day, January 2023. Want to know more? Get in touch. Looking to make the best use of the current market? If you're either expanding your property portfolio or looking to sell your current property, get in touch today. We'd love to help. I'm Wal Galbraith with the Ray White South Coast Group, and that was your last South Coast Snapshot for 2022. It is week 50.